for the entire NBFC as well as the housing finance space. But moving focus to the cement space, which also rode the market wave yesterday, we had an exclusive conversation with Maheshwari, Managing Director of UltraTech Cement, on how the demand outlook is for the sector going forward. Let's listen in.
The cement industry saw very subdued growth for almost about 6-7 years. But again, last year, the industry grew by almost about 9%, and the first half of this year, again, the industry has seen demand grow by about 13%. Now, clearly, it's very interesting to know that despite the slowdown in the real estate sector and the pressures which a lot of builders and construction industry has been facing because of RERA and other things, the positive impact of government's affordable housing schemes, low-cost housing schemes, we're starting to see the results of that. And because of that, the demand, even on the housing segment, grew by 9%. Of course, the major demand growth has come out of infrastructure sector, which has grown at almost about 15%. And that's largely been driven by road sector, where we've seen a very impressive growth of over 20%. And that's been happening for the last few years, thanks to the efforts of the Minister, Shri Nitin Gadkari ji, has done an outstanding job at pushing up the road sector. So railways, you've seen a big ramp up in expenditure. Now they're spending almost about 1.46 lakh crores every year. And while cement demand, cement consumption in rail sector is low, but when they spend that sort of a money, there's always a positive rub-on effect which it has on the cement demand. Again, we have seen irrigation demand come up very well, especially in certain states like Andhra, Telangana, Karnataka, Maharashtra. So those have led to an increase in demand despite the industrial and commercial activities we hope will now pick up, because generally there have been so much of overcapacity that that segment has seen relatively lower growth. So I think this, after a very long time, we are seeing some momentum pick up. And generally when the momentum picks up, it should continue. So hopefully we do hope that after a period of almost from 2010-11 till 2016, when the industry grew at below 5%, we should see some better times, and maybe the traditional growth rate, which is there of almost about 7% for over the last 25 years, hopefully we should revert back to the mean.
Since raw material prices are softening now, considering rupees also are low, crude prices are also hovering like in a good range as of now. Petcoke prices also been reduced by about 300 to 400 rupees. Are you foreseeing any improvement in the margins in third quarter?
So, we often tend to have the recency impact. So clearly, if you talk about the price of petcoke or coal or oil compared to last month, we are down. But if you compare to 3 months ago, we are still up. So again, these, I think we tend to get over-obsessed with the day-to-day fluctuations, which are of course very important, be it in any business. But one has got to look at the longer-term trend, and the world is in a very volatile phase. It's very difficult to predict where the costs are headed. 2 months back, no one would have said oil could come back so fast. At the same time, we keep reading that the capability of OPEC manufacturers to increase production beyond a level is decreasing. So with the increase in demand, it is likely to have some impact. So those are aspects one will have to live with. What we believe is that as an industry, that we should continuously focus on improving our efficiencies, and that's going to give us much more lasting benefit rather than worrying about movements in prices of materials which are subject to a lot of global forces.
So that's with regards to where the cement space is concerned. Demand is expected to be strong. In fact, a couple of cement companies have indicated these hike per pack in the next 1 to 2 months. So there is a possibility there could be an upbeat momentum with regards to cement counters, and that rally could continue. But let's quickly slip into a short break, and then we'll